I've kind of put together a very brief analysis here. It doesn't, I haven't done any sensitivity around it. This is just kind of all hard-coded here to give you an idea of, how this moves during different series of financing. So you raise one Series A financing, 6 months later you need a Series B, and so forth. Oh, I'm sorry. I'm sorry. So today you've bootstrapped your company. You put $25,000 into it of your own money. So essentially your post-money valuation is $25,000. You own 100% of the business. And then you go to raise a Series A. And this investor says, you know what? I think this business is actually worth $5 million. So your pre-money valuation is $5 million. The investor says, I want to own 38% of your company for $3 million. So your post-money is 8%, and all of a sudden your equity went down from 100% to 63%. But look at founder value. Before you were at 25, and now you're at $5 million. So although you own a very much smaller piece of a larger pie, essentially. So then you go into the Series B, and all of a sudden, this company is worth $15 million. You've tripled the value of this company with that investment, which is great. Somebody wants to put $30 million to work in your company, making your post-money $45 million, and all of a sudden, you go down to 21%. So you went from 100% down to 21% in 2 financing rounds. That kind of hurts, right? All of a sudden you don't even own a majority of your company anymore. Well, look what your founder value did. It went up to $9.4 million because the size of the pie, although your size of the pie increased or decreased, the size of the pie decreased. So then you're really knocking it out of the ballpark, and you have increased your pre-money valuation from $15 million to $100 million. And you're just really killing it, and a venture capitalist wants to put $60 million to work in your company. Well, then you drop from 21 to 13%, but again, your founder value has increased. Series D, you double it, somebody really wants to take a huge bet on you and puts $200 million to work. All of a sudden, you own 7% of this business. Something that you started out in your garage and was your baby, and you owned 100%, now you own 7%. That is not a large percent of a business. But that 7% is worth $28 million. So essentially what I'm trying to demonstrate here is that so many entrepreneurs get caught up in that 7%. Something that they just, it just doesn't seem right that they would own that much money, or that they would own that small of a percentage of a business that they started themselves. It's really their idea. What I'm trying to demonstrate is that although you own a smaller piece of the pie, that pie is much greater with venture capital investment. Now that's a question that you have to ask yourself, whether you need that venture capital investment to grow your business that way, because you will have to pay for it. If you think you can grow your business without that venture capital investment, you'll retain the 100%. Or if you think that there's a trade-off there. There's a trade-off. Can you grow your business at a rate that's acceptable to you without outside investment? Or can you go get some debt to finance your business? If you can't, if you need this money right now and you just need to accelerate the business, there are costs, costs with that, but there's also upside of bringing on that investment to accelerate the growth of your business, as well as the other value that the venture capitalist brings to your business that's not financial. So just very quickly here, in VC-backed companies, it is not uncommon for the founders to own 5 to 20% after all fundraising rounds. Something this is a traumatic event. It's traumatic for you to go from 100 to 5%. But it's something you need to be prepared for, and when you're out there raising venture capital, this will happen. You will get diluted. Again, look at it as a smaller piece of a much larger pie.